At some point, somebody probably told you to track your spending. Maybe you even tried it, downloaded the app, linked the accounts, watched the little bars fill up. Maybe it helped for about 2 weeks until a brand deal hit and the whole thing stopped making sense. Today, we're talking about why that advice tends to fail many creators specifically, and what they can build instead. I own two very different barbecue grills. I have a pellet grill, one of the newer ones that connects to your phone, maintains temperature automatically, tells you when your meat is done. It's basically the crock pot of barbecue. You set it, you forget it, and you come back 12 hours later and it's done. And I've also got an offset smoker. It's wood fired, it has no app, no automation, and if I want to smoke a brisket, I'm literally just sitting near it, feeding it with wood for about 15 hours straight. I'm constantly managing the fire, adjusting the vents, and paying attention. It takes skill, it takes some patience, and it can be exhausting, honestly. But here's the thing, I almost always reach for the offset smoker. Not because I'm trying to be difficult, but because the way I actually smoke meat, the control that I need, the adjustments matter, and they don't happen on an app. They happen in real time with my hands on the grill, paying attention to what's actually happening in front of me. And that tends to be exactly what's happening with budgeting advice for creators. Everyone's handing you the pellet grill, the app, the automation, the set it and forget it promise, but your income doesn't really work that way. Your money doesn't really work that way either. And the moment that you realize the tool doesn't fit, you're standing there with a dead app and no system at all. So let's talk about what actually tends to work instead. Hi, I'm Brad Clark, and this is Money Made Easy for Content Creators. I'm a certified financial planner, and I co-own Finchley Finance, a financial planning company built specifically for content creators and creative business owners. On this podcast, we break down the financial stuff that actually matters to your business, so you can stop worrying about money and get back to creating. All right, let's get into it. And I want to start by saying something that most personal finance content tends to skip entirely, which is that budgeting advice wasn't broken when somebody handed it to you. It just wasn't built for you. And that distinction tends to matter a lot. I'm going to cover 5 points that illustrates this point. So point number 1, why traditional budgeting was never built for you. Every budgeting system you've probably ever encountered, the 50, 30, 20 rule, the monthly spreadsheet, the expense tracking app, they all tend to share one foundational assumption, that money comes in on a regular schedule. Same amount, same day, every month. That's the entire architecture the system runs on. And for a salaried employee, that assumption tends to hold up pretty well. You know what's hitting your account on the 1st and the 15th. You can plan around it, and you can set categories, track against them, and the math tends to work. But that's probably not your life. Your income might look like a $4,000 AdSense payment one month, a $25,000 brand deal the next, and then 2 relatively quiet months while you're building something new. A traditional budget has essentially no idea what to do with that pattern because it was never designed for it. And here's the part that tends to surprise people. Creator income isn't just unpredictable in timing, it tends to be unpredictable in type. Most creators pull from somewhere between 6 to 8 different income streams at once. Brand deals, ad revenues, affiliate income, digital products, memberships, coaching. Each one of those streams tends to behave completely different. Some are relatively reliable and some are completely outside of your control. Some pay in 30 days, some pay in 90 days, and some hit your account the same week that you earned them. A traditional budget treats all of that as one bucket, and you don't have one bucket. You might have 8, and they all move at different speeds and different volumes. That's not a discipline problem, that's a design problem. And the fix tends to require a different design entirely. Point 2, the psychological damage of failed budgeting. This one doesn't get talked about enough, and I think it tends to be one of the most important things to name clearly. Here's what tends to happen. A creator tries to set up a budget. Maybe they download an app or they build a spreadsheet or follow some advice they found online. And for a little while, it sort of works. And then a brand deal hits or a slow month happens. and suddenly the whole system stops working or making sense. The categories don't add up, the projections are wrong, and the creator quietly closes the app and just decides that they're bad with money. That's the part I want to push back on directly. You're probably not bad with money. The system was wrong for you at the start. Standard budgeting advice tends to assume a steady paycheck. And when that assumption breaks down, the system breaks down with it. But here's what tends to happen next. The creator doesn't blame the system, they blame themselves. And that self-blame tends to create a pattern where financial planning starts to feel pointless. Why build something that's just going to fall apart again? The reframe that tends to help most is this. The problem isn't your discipline, it's the design. And once you understand that, you can stop trying to fix yourself and start building something that actually fits the way you earn. Point 3, the system creators actually need. Okay, this is where we get into what actually works. And I want to be clear up front. There's no single perfect system for every creator. What tends to work depends on your income level, your income streams, and your business structure. But there are a few core concepts that come up constantly, and understanding them tends to be the starting point for building something real. The first concept tends to go by a few different names. Income smoothing, the creator salary, the buffer approach. The idea is pretty straightforward. Instead of spending directly from wherever your income lands, you deposit everything into one central business account first, and then you pay yourself a fixed monthly transfer, a salary, into your personal account. Whatever's left in the business account tends to build as a buffer for slower months. What this does is essentially create the predictability that a traditional budget assumes, but you're building it yourself from the inside rather than hoping your income provides it. Your personal spending account tends to behave like a paycheck. Your business account absorbs the swings, and you're not white-knuckling it every time a slow month hits. The second concept tends to be a simple bucket structure. 3 accounts, one for income and business expenses, one dedicated to taxes, and one for personal spending. Every time you get paid and a payment hits, you make a percentage-based transfer before you do anything else. Not at the end of the month, not when it feels right, at the moment of income. That timing tends to be the key detail most people miss. And the third concept tends to be what I call the baseline budget. And this one tends to be the most important mindset shift in the whole conversation. Don't plan based on your best month. Don't even plan based on your average month. Figure out what your lowest realistic month tends to look like, the floor, and build your fixed commitments around that number. Everything above that floor tends to give you options. Below it, you've already planned for it. And by the way, if you're listening to this thinking, okay, I get it, but I have no idea how to actually build this for my specific situation. That's exactly what we do at Finchley. We help build your financial system around the way you actually earn, and we design it so nothing gets missed. Book a first look call at finchley.com. It's no charge, it's no pressure. Okay? All right, let's keep going. Point 4, the tax time bomb. All right, I want to spend a minute on this because it tends to be one of the single most common things that catches many creators completely off guard, and it tends to hurt. When you're self-employed, which most creators essentially are, nobody withholds taxes for you. There's no employer pulling money out before it hits your account. And what lands in your business account tends to be the gross amount. That could feel great until it's tax time. Self-employment tends to come with a tax burden that most creators dramatically underestimate. You're generally on the hook for both the employer and the employee sides of self-employment tax, which tends to run around 15.3% on top of your regular income tax. And a traditional budget almost never accounts for this as a dedicated line item, okay? It tends to get treated as a future problem until it isn't the future anymore. A reasonable rule of thumb, and I want to be clear, this could vary significantly depending on your specific situation, tends to be setting aside roughly 25 to 30% of every payment that comes in into a dedicated tax account that you don't touch. Not a mental note, a separate account. Because the money that feels like yours right now might not all be yours, and knowing that up front tends to change how the whole system feels. Point 5. From expense control to income architecture. It's the last point, and this one tends to be the mindset shift that ties everything together. Traditional budgeting tends to be reactive. You earn something, you track what you spend, and you try to stay within the categories. The whole system tends to look backwards, and for creators, looking backwards tends to be particularly unhelpful because last month might look completely different than this month, which might look completely different from the next month. What works better is something I'd call income architecture. Instead of asking, where did my money go? You're asking, what does my money need to do? You're identifying your reliable income streams versus your variable ones. You're building your fixed commitments around your floor, not your ceiling. You're making allocation decisions at the moment income arrives, not projecting it 30 days out and hoping the projection holds. The difference tends to be the difference between chasing your money and building a system that manages it for you. Budgeting requires constant attention, like the offset smoker. A well-built cash flow system tends to run in the background while you stay focused on creating. That's the actual goal, not a perfect spreadsheet. A system that works whether your income is $8,000 or $40,000 a month. Let's walk through a scenario. This isn't a real client, but it's the kind of situation we tend to see a lot. Meet Alex. Alex runs a fitness and lifestyle channel on YouTube. It's workout content, nutritional videos, and the occasional day in the life type of video. They've been at it for about 3 years, and they have a pretty nice channel, genuine audience, and a recognizable brand, and income that most people would consider to be serious money. In a good month, Alex might pull in somewhere around $15,000 to $20,000. They get AdSense, 2 or 3 active brand deals, an affiliate program with a supplement company, and a digital training program that sells just consistently in the background. By most measures, Alex is doing well. The content's working, and the income's there. But here's what Alex comes in with: a vague, persistent feeling that the money isn't adding up the way it should. They're not broke, but they're not getting ahead either. And every time Alex tries to get organized, the whole system lasts about 2 weeks before something throws it off and the whole thing gets abandoned. Sound familiar? So, what do I actually think about when I sit down with somebody in Alex's situation? A few things. First thing, I'd want to understand the income floor. Not the best month, not the average month, the worst realistic month. Because Alex tends to anchor planning around those $15,000 to $20,000 months. But what actually tends to happen in January or during a stretch where the algorithm shifts and brand deals dry up? If that floor turns out to be closer to $6,000 or $7,000, that changes everything about how we build the system. Second, I'd want to map the income streams separately. Alex has at least 4 distinct revenue sources, and they all tend to behave differently. AdSense might be relatively predictable month to month. Brand deals could be lumpy, 2 in one month, none in the next. The digital product tends to spike after a promotional push and then it quiets down. Affiliate income might trickle in on a completely different schedule. A traditional budget treats all of that as one number. What Alex actually needs is a map. Which streams tend to be reliable, which ones are variable, and which ones are essentially bonus income when they show up. Third, and this tends to be the conversation that lands the hardest, I'd want to talk about what's actually happening at the moment income arrives. Because here's what I'd suspect is going on with Alex. Money hits the account, it feels like a good month. Some of it goes to business expenses, some of it goes to personal spending. A mental note gets made about taxes, and then a slower month comes and the mental note turns out to have been optimistic. That pattern is incredibly common among creators at Alex's income level. Not reckless spending, just the absence of a system that allocates money before it gets absorbed. So, what would I likely recommend? A few things in order. First, we'd figure out Alex's actual baseline, the floor number that covers the non negotiables, business expenses that keep the channel running, personal fixed costs, and a realistic tax set aside. That number tends to become the anchor for everything else. Second, we'd set up a simple 3-account structure. One business account where all the income lands, one dedicated tax account that receives a fixed percentage transfer every single time a payment arrives before anything else happens, and one personal account that receives a fixed monthly transfer, Alex's salary essentially, regardless of what the business account looks like that month. The business account absorbs the swings. The personal account tends to feel stable. Third, we talk about the digital product and affiliate income specifically, because those tend to represent the most interesting opportunity for Alex. Right now, they might feel like bonus money. With a little structure, they could become the foundation of Alex's buffer, the thing that makes a slow AdSense month feel manageable rather than stressful. Alex came in feeling like a discipline problem. What Alex actually has is a design problem. And that's much more of a solvable thing. All right, before we wrap, I want to hit a few questions I get asked a lot about this topic. Question 1. I've tried the separate account thing before, and I just end up moving money around anyway. How do I actually stick to it? This one tends to come down to friction. The more inconvenient it tends to be to move money out of the tax account or the buffer account, the less likely you are to do it casually. Keeping those accounts at a completely separate bank from your primary checking tends to help a lot because there's a transfer delay built in. It's not impossible to access, it's just annoying enough that you tend to think twice. And that friction tends to be the whole point. Question 2. What percentage should I actually be transferring to taxes every time income hits? And the honest answer is it depends on your income level and your business structure. But what a reasonable starting point is for most self-employed creators could be somewhere between 25 to 30%. If you're running an S Corp or have a more complex setup, that number might look different. The important thing tends to be that you're making that transfer at the moment income arrives, not setting aside a mental note and hoping that the money's still there in April. Question 3. How do I figure out what my actual baseline number is, the floor? Start by pulling the 3 lowest income months from the past year. Not your worst ever, just the 3 softest in recent months. Average those together, and that tends to give you a realistic floor that accounts for normal slow periods. Then map your non-negotiable expenses against that number. Business expenses that keep you operational, fixed personal costs, and your tax set-aside amount. If your floor covers those 3 things, you tend to have a workable foundation to build from. Question 4. Does this mean I should never use a budgeting app? Not necessarily. Some of them could be genuinely useful for tracking business expenses or getting a snapshot of where things stand. The issue tends to be using them as the primary system for managing variable income. A budgeting app tends to work best as a visibility tool on top of a cash flow structure that's already doing the heavy lifting. It's a dashboard, it's not the engine. So let's bring this back to my 2 grills. The pellet grill tends to be a great tool for the right job. But if you're trying to smoke a brisket the best way it actually needs to be smoked, you need something built for how that process actually works. Not the automated option, the right option. That tends to be exactly what we've been talking about today. The budgeting advice you've probably been handed wasn't bad advice for everyone. It just wasn't built for the way that you earn. And the moment you stop trying to fix your discipline and start building a system designed for variable income, the whole thing gets a lot more simple. You don't have to figure it all out today. Just pick one thing from this episode, the baseline number, the tax account, the creator salary concept, and just start there. That tends to be how the whole system gets built. That's it for today. If this episode helped you see why the standard budgeting advice tends to fall flat for creators and gave you a clearer picture of what to build instead, then it did its job. If you want help actually building that system around your specific income, that's what we do at Finchley Finance. It starts with a first look call. It's no charge, it's no pressure, it's no commitment. It's just a conversation to figure out if we might be a fit. You can book one at finchley.com. If this episode resonated with you, subscribe and share it with a creator friend who needs to hear it. You can also find us on Instagram at Finchley Finance. Thanks for listening. I'm Brad Clark, and this has been Money Made Easy for content creators. Now go get back to what you love. Brad Clark is a financial advisor, and Lucinda Clark is a registered administrative assistant of Cetera Wealth Services, LLC, member FINRA, SIPC. Finchley Finance is located at 15072 Snowsill Drive, Frisco, Texas, 75035. Brad offers securities through Cetera Wealth Services, LLC, member FINRA, SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views expressed on this podcast are for informational purposes only and are not necessarily those of Cetera. They should not be considered specific advice or recommendations for an individual. Neither Cetera nor its representatives may give legal or tax advice. The views and opinions contained in this material are those of the author and not necessarily the opinion of Cetera, and not a recommendation or solicitation to buy or sell any securities or investment products mentioned herein. This information is from sources believed to be reliable, but Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. Guests on the show are not affiliated or registered with Cetera Wealth Services, LLC unless specifically stated. Any information provided by the guest is in no way related to Cetera Wealth Services, LLC or its registered representatives. Due to volatility within the markets mentioned, opinions are subject to change without notice. Any references to specific companies, platforms, brands, or products through this podcast, including but not limited to social media platforms, content distribution services, affiliate programs, e-commerce platforms, or consumer brands, are made solely for educational and contextual purposes relevant to the content creator industry and primarily to distinguish a company's goods or services, establish context, and prevent listener confusion. Such references do not constitute a research report, investment recommendation, solicitation, or endorsement of any kind and should not be interpreted as advice to buy, sell, or hold any security instrument or to participate in any particular trading strategy. Finchley Finance and its representatives do not hold Series 86 or 87 registrations and do not publish research reports. Opinions expressed by the owners of this content do not reflect an endorsement by Cetera Wealth Services, LLC, or its affiliates. Any hypothetical examples, scenarios, or case studies discussed in this podcast are illustrative only and do not represent the actual performance of any specific investment, strategy, or individual. Any figures, percentages, dollar amounts, or numerical examples used may be hypothetical or illustrative in nature and are not intended to represent guaranteed outcomes, specific investment returns, or verified third-party data unless explicitly stated otherwise. All information herein has been prepared solely for informational purposes. Past performance does not guarantee future results. All investing involves risk, including the possible loss of principal, and there could be no assurance that any investment strategy may be successful. Words or phrases that may appear absolute, predictive, or superlative in nature, such as will, always, never, best, should, would, or similar language, are used conversationally for clarity and educational purposes only, and should not be interpreted as promises, guarantees, predictions, or endorsements of any specific financial outcome, strategy, or product for any individual listener.